All right, today we're diving into a really fascinating financial showdown. We're putting two heavyweights from India's booming alcohol market head-to-head, Tilaknagar Industries and Allied Blenders. We're going to crunch the numbers, look at the strategy, and uncover some hidden details to figure out who might just win this race.
So the big question is, who's going to be the next king of this massive market? Let's get into it.
Okay, first things first. To really get what's at stake here, you have to understand the playing field. And that field is India's absolutely enormous and fast-growing market for spirits. So why is this market just exploding right now? Well, it boils down to two main things. First, rising incomes mean people just have more money to spend. And second, there's this huge trend towards what they call premiumization. Basically, you and I are more willing to shell out a bit more for better quality brands. This whole situation creates a gigantic opportunity for the right company. And that opportunity leads us straight to our two main contenders in this financial face-off. In one corner, you've got Allied Blenders. They're a giant, famous for their mega brand Officer's Choice, and they have this huge portfolio of over 25 brands, hitting everything from the mass market to the premium stuff. And in the other corner, we have Tilaknagar Industries. They're the undisputed champion of the brandy market with their bestseller, Mansion House, and they run a more focused ship with about 15 brands. All right, let's get down to the nitty-gritty and put their financials side by side. Honestly, this is where the story really starts to get juicy. So round one, sales growth for the second quarter of fiscal year 2026. And wow, Allied Blenders comes out swinging. They posted a really impressive 14% growth, mostly because their whiskey brands did so well. That easily beats Tilaknagar's 6%. But wait a minute, take a look at this. Yeah, Allied sales numbers are way bigger, but their net profit margin, that tells a completely different story. Tilaknagar is rocking a super healthy 13% margin. That's more than double Allied 6.3%. And that brings up a really important question.
How on earth can a company that makes less than half in sales be twice as profitable in terms of its margin? What's going on here?
Well, the answer comes down to one word, debt. See, even though their operating margins are pretty similar, Allied Blenders is carrying a lot of debt, and those high interest payments are just eating a huge chunk out of their profits, dragging that final number way down. Okay, so let's switch gears and talk about the valuation game. This is all about trying to figure out which stock is actually the better deal for the future. And to do that, we're going to use a really neat tool called the PEG ratio. Now, don't worry, it sounds complicated, but it's pretty simple. It just takes a stock's price and compares it to how fast the company's earnings are growing. The key thing to remember is that a low number, especially anything under 1, is often a sign that a stock might be a good value.
And check this out. This is a perfect example of a potential trap for investors. Just looking at this, Allied Blenders seems like a slam dunk. Its PEG ratio is just 0.17. That's way better than Tilaknagar's 0.43. So based on this number alone, you'd think Allied is the clear bargain, right?
But is it really that simple? Is the choice that obvious? You've probably guessed by now, there's a pretty big twist to this story. So the reason Allied's PEG ratio looks so amazing is because of its mind-boggling 400% profit growth. But that number has a huge catch. It's something called the low base effect. Think about it like this. If your profit goes from just $1 to $5, that's a 400% increase. The percentage looks massive, but the actual dollar amount is tiny. That's exactly what's happening with Allied's profits. And that brings us to the other side of the coin. Tilaknagar's profit growth isn't some one-off explosion. Instead, what you see is their profits growing steadily and consistently, year after year, for the last 3 years. That suggests a business model that's way more stable, predictable, and maybe more reliable. So after peeling back all those layers, the growth, the profits, the valuation tricks, we're back to our main question. Who is the future winner here?
So let's look at the final scorecard. With Allied Blenders, you get explosive sales growth and a very tempting valuation. But that comes with the risk of high debt and a profit growth number that might be a bit misleading. With Tilaknagar Industries, you get slower growth on the top line, but it's way more profitable and has a solid history of steady performance. It's a classic choice, really. High risk, high growth versus stable and profitable.
And that brings us to the end, where we turn the question over to you. Looking at all the evidence, where would you place your bet? Do you go for the explosive potential of Allied Blenders, or do you prefer the steady, profitable path of Tilaknagar? Who do you think is the future winner?